You know, when a client gets a huge settlement for a personal physical injury, everyone, including the client, assumes that money is tax-free. But there's a hidden danger, a real minefield that tax pros call the interest trap, and it can be hiding inside that settlement, waiting to trigger a massive and very unexpected tax bill from the IRS.
So let's just ask the question head-on. How on earth can a recovery that's supposed to be tax-free suddenly create this giant tax problem? Well, the answer comes down to one very specific part of that settlement, prejudgment interest. And believe me, understanding this is absolutely crucial for anyone practicing in this area.
Okay, here's our game plan for this deep dive. We're going to follow what you could call a doctrinal funnel. We'll start big with the major philosophical clash between tort law and tax law. Then we'll narrow down to the key court cases that set all the rules. From there, we'll get into the nitty-gritty, the painful math of the trap, and finally, we'll talk about the specific, practical strategies you can actually use to protect your clients.
To really get this, really get it, we have to start way up high, at the 30,000-foot view. We have to understand this fundamental conflict between how tort law and tax law see the exact same pile of money.
Think about it like this. Tort law's entire goal is to restore someone, to make them whole again. Tax law, though, it couldn't care less about that. Its goal is to tax any and all accession to wealth. It's right there in the gap, in the chasm between these two completely different philosophies that this whole problem of taxable interest is born.
The analysis for any tax issue really always starts with Internal Revenue Code Section 61, and its language is just incredibly broad. All income from whatever source derived. What that means is the IRS's default setting is that every single penny that your client receives is taxable income, unless you can point to another law, a specific one, that carves out an exception. And for our plaintiffs, that exception, that shield, is IRC Section 104A2. This is the famous exclusion for damages someone gets on account of physical injuries. It's what protects them. But, and this is a huge but, the courts have interpreted that little phrase, on account of, with almost surgical precision when it comes to interest. And that's where the shield cracks wide open.
So here it is. This is the whole ballgame. The courts have basically driven a wedge right down the middle of the settlement. They've said that while the core damages, those are paid on account of the injury and are tax-free, the interest is paid on account of the delay in getting that money. It's essentially treated as rent for the use of money, and that makes it taxable income. End of story.
Now look, this is not some brand new theory the IRS just cooked up last week. This rule has been cemented by decades of court cases. So let's actually walk through the major cases that built this trap brick by brick. If you need to understand this field, you have to start with Kovac v. Commissioner. Just burn that name into your memory. This is the one. It's the definitive authority, the case that really set the stage for everything that came after.
So the case was about a tragic wrongful death suit. And after a judgment, the Kovac family received a total payout of more than $2.2 million.
Okay, now this slide, this is where the story gets really wild. Just look at this breakdown. The actual damages for the wrongful death, just under $1 million. But the prejudgment interest, which was required by Michigan state law, was over $1.25 million. More than half the entire recovery was interest. The family's argument was pretty straightforward. They said, hey, Michigan law calls this interest a part of the damages. Makes sense, right? But the tax court was not having it. They said in no uncertain terms that state law labels mean absolutely nothing for federal tax. The character of the money is decided by federal law, and under federal law, interest is interest. It's payment for the time value of money, period. Now, to be fair, there was a pretty compelling counterargument out there. Judge Begay's dissent in Kovac basically said, look, prejudgment interest isn't like interest on a car loan. It's a core part of the damages needed to make someone whole. And for a little while, it seemed like that argument might win. A district court in a later case, Brabson versus United States, actually agreed with that dissent. But that little glimmer of hope for taxpayers, it didn't last long. The 10th Circuit immediately reversed the lower court in Brabson, and then the First Circuit did the same thing in another case called Raspod. Together, these cases slammed the door shut and created a national consensus across the federal courts. The doctrine was cemented, interest is interest, and it's always taxable.
So we've got the legal theory down. Now, let's look at how this abstract idea turns into a real-world financial nightmare for plaintiffs. This is where you can see how the trap actually snaps shut.
The first gear in this nasty machine comes from a Supreme Court case, Commissioner v. Banks. What the court decided here is a real gut punch. They held that a plaintiff has to include the entire taxable part of a settlement in their gross income,
even the money that goes straight to their lawyer. Think about that. You are taxed on money you literally never see. Let's walk through the horrifying math here. Let's say you have $100,000 in taxable interest. The attorney's contingent fee is 40%, so 40 grand goes to them. That leaves 60 grand for the plaintiff pre-tax. But thanks to the bank's case, the plaintiff's gross income is the full $100,000. At a 37% tax rate, that's a $37,000 tax bill. So the plaintiff's final take-home pay is just $23,000. This is the trap in action. The effective tax rate on the money they actually got, a jaw-dropping 61.7%. Now, you might be thinking, well, hold on. Can't the plaintiff just deduct that $40,000 in attorney's fees? And before 2018, they could have. It was a miscellaneous itemized deduction. But then the Tax Cuts and Jobs Act came along and changed everything, making this trap even more brutal. This table lays it all out pretty clearly. Physical injury damages, tax-free. Punitive damages, taxable, goes on a 1099 MISC. And then you see pre- and post-judgment interest, both taxable, both reported on a Form 1099-ant. But the real killer, the absolute dagger, is that last line. From 2018 through 2025, the attorney fees you paid to get that taxable interest are completely 100% non-deductible for your client.
All right, we've spent a lot of time on the problem, and it's a severe one. But the good news is you are not helpless here. The single most powerful tool you have to avoid this trap is a proactive strategic allocation right inside the settlement agreement itself.
Look, the IRS and the tax court always want to know the intent of the payer. If your settlement agreement says nothing about allocation, they're just going to make up their own minds, usually by looking back at the original jury verdict. And as we saw with Kovac, that's a recipe for disaster. A specific allocation, on the other hand, creates a powerful record of what both parties intended. I'm telling you, silence is fatal, being specific is your best defense.
So what's the gold standard here? It's what's known as the McShane Strategy, named after a critical tax court case. The court actually accepted a zero-interest allocation in a settlement. But, and this is key, only because three specific conditions were met. 1, the settlement happened before the judgment was final, while it was on appeal. 2, this meant a real risk of litigation still existed for both sides. And 3, the agreement specifically said the entire payment was for tax-free damages and waived any claim to interest. You have to check all those boxes.
Okay, let's bring it all home. Let's boil everything we've talked about down into a final list of actionable best practices you can use to navigate this thing and, hopefully, escape the trap completely.
First, negotiate the tax stuff early on. Make the allocation a critical part of the deal, not some afterthought you tack on at the end. Second, always ask for separate checks. One for the tax-free damages, another for any taxable bit. This stops you from getting one giant confusing 1099 for the whole amount. And finally, if the other side is getting nervous about this, you can use indemnification clauses. You basically offer to cover their tax risk if they agree to your allocation and reporting. The courts have made it crystal clear. Interest is taxable. The winning move isn't to fight the law, it's to manage the facts with careful, proactive drafting of your agreements. So the question I'll leave you with is this. Now that you've seen the trap and the tools to get around it, are your settlement agreements truly built to protect your clients and stand up to IRS scrutiny?